Welcome back to our series on The Intelligent Investor by Benjamin Graham. Today, we explore a deep dive into special situations, bargain bonds, and how the enterprising investor can seize rare opportunities when others hesitate. This is Graham's roadmap for advanced investing, rooted in logic, value, and courage. In the 1970s, rising interest rates caused even high-quality bonds to trade at steep discounts. AT&T and Deere bonds, for example, were selling far below par, not because they were unsafe, but because they offered lower coupon rates. These were market mispricings, and for the enterprising investor, they were golden opportunities. Graham says, pay attention when sound assets are being sold at bargain prices simply because the market has shifted its mood. One of Graham's favorite hunting grounds? Special situations, events like mergers, liquidations, reorganizations, and bankruptcies. Take the defaulted railroad bonds of the 1940s. Investors who studied the legal filings and reorganization plans saw the value before it returned and reaped incredible gains. But he warns, these are not for amateurs. They require experience, judgment, and nerves of steel. Arbitrage opportunities also arose from things like utility breakups or legal disputes. The public hates complexity. But Graham points out, when the market fears lawsuits, it often undervalues the securities involved. One classic Wall Street saying, never buy into a lawsuit. But Graham flips it, saying that very fear may create the undervaluation enterprising investors thrive on. Next, Graham distinguishes between defensive and enterprising investors. The defensive investor wants simplicity, safety, and peace of mind. The enterprising investor, by contrast, is like a business owner, applying study, strategy, and commitment. There's no such thing as being half a businessman. You either treat investing seriously or stick with a simple, defensive strategy. Graham then issues a warning. Avoid paying full price for foreign bonds, preferred stocks, and secondary common stocks, unless they're deeply discounted.
Why?
These securities often come with low flexibility, low liquidity, or high risk. For defensive investors, avoid them altogether. For enterprising investors, only touch them when they're available at a true bargain. What about secondary stocks, the less known, less loved shares? They can be hidden gems. But Graham emphasizes, they should never be bought at market highs. Instead, they should be purchased when their prices are well below their fair value.
Why?
Because the market tends to undervalue these stocks until results force it to take notice. To wrap up, Graham says the intelligent investor must first choose their role, defensive or enterprising, and stick to it with discipline. For enterprising investors, special situations and undervalued securities offer exceptional rewards, but only when approached with research, patience, and sound judgment. Remember his mantra, investment is most intelligent when it is most businesslike. Thanks for watching, and stay tuned for our next video in the series. Don't forget to like, share, and subscribe for more timeless investing wisdom.